Matthew, here goes my first question to you. So you have been in the investment management business for a decade now, and you have grown Peterson Capital Management's AUM 20 times with sustainable market-beating returns. For the young audience listening to the show, could you please explain your investment philosophy of buying great businesses with great management at a great price? And most importantly, how do you define a great business? And what differentiates great management from the mediocre or the crooked ones?
Fantastic. Amit, thank you for the kind introduction and a very thoughtful question to kick us off. It's a pleasure to be here. And for a brief bit of background, again, as you mentioned, we've been running Peterson Capital Management now for about 11 years. And you mentioned this 20x growth, but that's a little bit exaggerated here because we've actually been raising capital and compounding capital. And so when we add those two together, the numbers look quite astronomical. But we have done quite well. We've been running the fund now for almost 11 years. And Peterson is a globally focused fund with a very concentrated long-term value-based approach. And then, as you mentioned, Talus was launched with Masoud Eliotalu, just an incredible individual who I met. I had the pleasure of meeting through Guy Spears ValueX conference about 7 or 8 years ago.
Great.
Masoud has been focused on the Turkish equity markets for his entire career. So for about 25 years, he's been focused on the same couple hundred businesses. And those businesses he was the chief investment officer of ABN AMRO. He's been analyzing these companies, the managements, and the prices and the opportunities for decades. And so we are really privileged to have Masoud involved in the management of the Talus Capital business. So to address your question, Amit, a great question. There's a couple of things that I think your audience can benefit from. First is we have a very important framework. Even before we get to the framework that you're discussing, which is the focus on our process. And I think a lot of folks in this industry are so focused on the outcome that they don't have the proper process in place. We focus on the process, not the outcome, because if the process is done properly with a positive MPV in terms of probabilistic outcome, the outcome will follow. So we're always trying to enhance our process. And our process is actually quite simple if you were to lay it out on paper. We start with a sort of 13F analysis, which you can do here in the United States. Every fund of size is required to file with the SEC each year. They're a snapshot of their portfolio, and actually each quarter. So every 90 days, we receive, and it's actually about 60-something business days.
Right.
We get to see the updated portfolio of prominent value fund managers, and it's particularly important in value because the turnover is so low. So we can see what Bill Ackman's doing. We can see what Charlie Munger or Warren Buffett are doing. We can just open the filing and see exactly what Guy Spear or Manish Pabrai have done recently. So this is quite interesting information. It allows us to really narrow down our focus to a basket of securities that are most likely to have the mispricing. Though, these Nobel Prize winners for efficient market hypothesis, they're mostly right. The markets are usually efficient. So
yes.
If you were to just look around the world, you'd spend a lifetime trying to find these mispriced opportunities. But through these 13F filings, they really lay it all out for you. And to that point, I want to emphasize that screening is something that people use commonly because it's simple, but it doesn't work. When you're screening, you're incorporating all sorts of information from the financial statements that can be somewhat misleading. And then you get misleading output. So you start with the wrong basket of securities. You're starting with the value traps. You're starting with the low PEs and no growth opportunities. And that's just the wrong place to begin. So we're very pleased that we have this 13F basket that we can start analyzing. From there, we do the financial analysis, and we try to understand, are these good business models? Are they poor business models? And from there, then we work out, our buy price and how we'd like to approach entering the security. So we do something very unique where we're writing puts as a tool to buy the stock. And through that method, we end up with prices that are below what exists in the market. So we can buy for less than a retail investor would pay, and even a professional investor in most cases. And in fact, we write covered calls if we want to exit after usually a series of many years. And we pick up premium on that end as well. So we get out and exit for above market prices. And that's a very clear advantage within our process. And then we focus on sort of portfolio construction. And portfolio construction is essential. You need to optimize your diversification. I think most people are far too diversified. In fact, we call it diversification. So people are, portfolios I look at regularly have introduced new, seemingly diversifying positions that will clearly perform with a lower return than sort of a higher conviction idea. So it's a pointless addition to a portfolio. It may or may not add true diversification because correlations tend to move to 1 during a crisis, but it certainly introduces a lower return. So we focus, we sort of the guideline we use is Kelly criterion. It's a pretty nice way to look at how to concentrate a portfolio. And again, that also helps us educate us into what 13Fs we should look at. So a 13F that holds 30 positions is not of interest to us. A 13F that holds 8 positions with $1 billion under management is of clear interest because a new position is very high conviction for that manager. So with that, you ask a couple of important other questions, and they all come from even another perspective that I have. And it's that one thing we are looking for, but really we are excited to discover, is off financial statement value. What we want to find is the things that are missing from the financial statements, so all the screeners are looking the other direction. And that is what gives us oftentimes a mispriced opportunity. So if you have an outstanding business model and you have outstanding management, then the price tends to be outrageous. Okay. And if you're in that situation, it's not really value opportunity. It's not something that we're necessarily interested in. So to get a good value, to get a good, fair, even buy price, the herd mentality needs to be missing the opportunity. And so a lot of times that's something you can discover with off financial statement value. So where does that lead us? That leads us to understanding like what of these, if we're going to concentrate into 6, 7, 8 businesses that are really long-term, we're going to become owners of these firms. We can be extremely selective. So we're only going to focus on the very best business models. Now, we don't want every business model to be the exact same business model because we do want a little diversification, but we want just the very best. So those are business models where there are modes, where there's cash flow that's actually growing and increasing, where the model can introduce new products when past products are stale. There are businesses where the customer is getting more value for whatever activity, service, good is being purchased than they're paying. The perceived value is much higher. And they're businesses that are really win-win with the whole ecosystem. So we can't have a business that's pleasing customers but offending the regulators. We need to have everybody wanting this business to succeed and benefiting from the success of the business. That could be customers, suppliers. It can be, the regulatory bodies. Everybody should be winning. And if you find a great business model like that, you can have a lot of tailwinds affiliated with that business. So, there's great businesses in the SaaS space right now. So SaaS business, there's a lot of upfront investment that takes place to create, an adequate product. But then if the price doesn't really recognize, if the market price doesn't reflect the investment that was made previously, you may have a very wide margin product that can persist for many years. And the cost, the incremental expense is going to be very low. Something like that is a very attractive business model to us. Things that are less attractive could be, we used to actually have some big metal stamping investments. And those are actually less attractive businesses. So like a OEM or an auto manufacturer has, through our own evolution, we've recognized that this business model is not very attractive because there's so much upfront expense and investment. And if you get the market wrong, the interest in whatever product or design, you can make a very big mistake. You can make a big investment without a lot of cash flow coming in. And with a low margin and high competition business, it becomes tricky. You want like monopolies, oligopolies. I mean, I'm sorry to say, a monopoly might not be a good word in business, but if you find yourself in a monopolistic situation, you're probably going to earn a whole lot of profit. Okay, so
absolutely.
These are the business models that are attracted to us. Now, the interesting thing is you can have a great business model and you could have terrible management. They could be corrupt. It could be, they're doing, they're stealing. But usually I find that's not the case. It's that they sort of misinterpret the market and they're just making errors. And if you have management that's sort of moving in one direction and it's the wrong direction, that's a problem. So you get a great business model that's spinning off all this cash flow. And then management gets to determine what they do with that cash flow, right? They could buy back their stock. They could pay a dividend. They could pay off debt. They could start a new internal business. They could start acquiring other businesses. They're kind of these 5 big buckets. And if the value of the business is really undervalued, maybe they would benefit a lot from buying back shares. But instead, if the management's out there paying off debt and issuing a dividend, they could be perhaps destroying or not creating as much value. If they're out there making poorly timed acquisitions, they could be completely destroying the beautiful cash flow from the business model. So that's why you need this pairing of extraordinary, excellent management with the great business model, because the management is controlling the cash flow coming from the business. And so a lot of what you need, unfortunately, is a long track record to assess how the quality of the business making decisions. And but I think if you look in the space long enough, you can start identifying the key players and you can identify the teams that move around. So we have sort of internally, we have all these maps of the boards of directors and the executives and where they've moved and who else they're affiliated with. And these directional situations can actually alert us to new opportunities. And
right.
If I give you a clear example from the Peterson portfolio, I've been following Berkshire for many decades, 2+ decades now. And so I've been following Berkshire, Warren Buffett and Charlie Munger. And about probably 12, 13 years ago, because of that, I became very interested in the West Coast situation that used to exist, and then ultimately Daily Journal. And I started attending the Daily Journal meetings back in about 2011. These meetings, Charlie Munger runs Daily Journal, but there were only maybe 1,000 people attending the meetings when I first went. So there would be 40,000 at Berkshire Hathaway, and then it'd be a room full of 1,000 at Daily Journal. And it just didn't make any sense because you have Charlie Munger standing there. You can ask him direct questions, even sit down and take a picture with him if you'd like. It's just not crowded. So by following, this is a very high level broad scope, but by following the management teams around, you can find these new opportunities. Now, Daily Journal ended up being, we now own 1% of Daily Journal. Daily Journal is a large position in our portfolio. And it's because we were following management around to the other companies that they're running. And we found that Daily Journal, despite looking like a newspaper business, which screeners would miss because it looks like newspapers are a poor business model today, it's actually a pseudo SaaS business. And that's all hidden from public view. So it becomes quite attractive. So we're looking for these great management teams. A lot of times you can follow them from one business to another, even outside of the 13F pool. So Daily Journal was not in the 13F pool when we were looking at it. And now we look at Daily Journal to see what else should be in our 13F pool. So So there's a lot of positive feedbacks that happen from approaching things this way. Finally, you mentioned, how do we determine the pricing and things? So we look at the greatest business models and we look at the greatest management teams, and we need to find a very fair price. So I touched on this before, but when you have these extraordinary businesses and managers, the price is usually astronomical. And so actually, we need to wait for oftentimes times like now, times where the whole market is sort of falling a bit, things are coming down a little bit. When that happens, a lot of times these great companies that might not screen well start looking really attractive. And it's during troubling times when you can upgrade your quality of your portfolio. So you can take an existing attractive looking position and maybe just very quickly remove it from the portfolio and just step up in quality. And when things come back, you have a beautiful portfolio that's maybe you've got a very fair price or even a very inexpensive price for a wonderful business with excellent management, and you can hold on to those. They're like a Fisher compounder. You can hold on to those businesses for years, maybe decades without touching it. In fact, you should be holding on to those kind of businesses for years and decades without touching them. And so hopefully that answers some of those first questions. Happy to go on to more on any of those aspects.